Welcome out to Tackle Trading's Technical Analysis 101, Tackle Trading 101, that is, the art of the reversal. It's a pleasure to be with everybody here tonight, and hopefully you get a lot of value out of this webinar as we detail the art of the reversal. Reversal analysis in the market is very, very powerful if you couple it from a multiple time frame perspective specifically. Our focus here tonight is we're going to be focusing on the step-by-step process as we detail reversals in the marketplace. We're going to be looking at it from a 5-step process, slowing momentum, double bottoms, double tops, breaking out of resistance. And the reason I feel this is such a relevant topic is because of where we're at in the market today. We're sitting on the 200 weekly moving average, which can oftentimes be considered an origination point when it comes to powerful support levels, and the expectation for potential reversals at these key origination points are certainly on the radar. And so we're looking at an environment in the market where we're going through a little bit of short-term reversal scenarios, and we're going to talk about the strength of the reversal. And as we do so, we're going to detail that step-by-step process in the art of the reversal. And hey, everybody, hashtag Team Tackle to everybody out there. Going to have a lot of fun here tonight. Going to spend about you never know, 30, 45 minutes, but we'll get through the content. If you have any questions, obviously, go ahead and type them into chat. And if you're watching this on replay, you can always hit me up in the either in the new trader channel on Discord, the general chat on Discord, or if you want to talk specifically towards technical analysis, that would be the Step System channel there in Discord. And for those of you who are new to tackle trading or trading in general, Tackle Trading is an educational company. Our focus, our heart, our passion is on education, teaching people how to navigate the markets, and Tackle Trading specifically as a community to help each other navigate these markets. And it can be a challenging environment in the market. The first 10 months of this year have been just that, a challenging environment. It's helpful when you have other people that you can rely on, talk to, get your questions answered. That's what community is all about. And our ecosystem at Tackle Trading is pretty deep, pretty detailed, and there's a lot of material out there. So we have reports, shows, courses, blogs. We have a ton of tools, social media, but specifically Discord. And if you have any questions, you can always email team@tackletrading.com. You can go to bit.ly/jointacklepro if you want to get a 15-day free trial for all those amazing things we like to talk about in our pro member community. And once again, if you have any questions, you can always hit us up in Discord or email team@tackletrading.com. My name is Coach Matt. I'm going to be your trainer here tonight as we detail the art of the reversal from a technical analysis perspective. I'm the CEO of Tackle Trading, one of the founders, along with some other amazing people as well. But our focus here is to really kind of learn the techniques of reversal analysis. And our community knows me pretty well, so I don't need to give a detailed intro there. Our focus here tonight is obviously on reversal analysis. We're going to be focusing on the types of reversals, but specifically the process of the reversal. It's pretty easy to historically look back and talk about where you should have bought something. It's pretty easy to give a quote from Warren Buffett saying, "Oh, when there's blood in the streets, go out and buy." That's pretty easy to do. It's a little bit more difficult to go through that in the moment because there's so much emotion in the market right now. There's so many different takes in the market. There's so many different forms of analysis that are smacking us in the face. Inflation, 40-year highs. Every other day we get another geopolitical situation that nobody likes. It's just a very, very nasty environment out there in the market. But at that point, there's always going to be a point in the marketplace where everybody in the world is screaming bloody murder, but the simple reality is the market finds some degree of stabilization, then it starts to punch up, and at first, it's like, whoa, what's going on? Why is the market going up in the face of PMI numbers that are showing contraction economic territory? Why is the market going up when we haven't seen a Fed pivot? Why is the market going up in the face of some of these more, damning headlines out there? Well, the market's always forward thinking. It's always thinking 3 months from now, 6 months from now, a year from now. It's always projecting forward analysis. And so the market's always forward thinking Whereas a lot of the things we talk about in our daily lives, a lot of the things we talk about with our friends, our family, our associates, our coworkers, and so on and so forth, they're seeing it what they're dealing with on a daily basis right now, today, what's impacting them right now. But what's the market thinking about? We had those conversations. We've been having those conversations for a really long time. The market's thinking about the future. And that's what reversal analysis really kind of is helping us navigate difficult economic times, difficult headlines in the market, lack of theme in the market, and we can kind of get the truth of the market when we focus on the price action to a certain extent. Mark Twain said history doesn't repeat itself, but it certainly does rhyme. That is certainly true when it comes to technical analysis. Technical analysis is not an end all be all of everything. Technical analysis is the truth of the marketplace. It's not a matter of what somebody says, buy this, sell that. It's a matter of the collection of the buyers and the sellers and what the entire market thinks. And these create trends, and trends are nothing but a collection of different patterns in the market. In fact, when I teach trend analysis in the market, it's really a matter of understanding the pattern within a trend. And when you get into the specific patterns within trends, we talk about higher highs, higher lows, or the 1, 2, 3 pattern within a bullish cycle, or the lower lows, lower highs, or the 1, 2, 3 pattern within a bearish cycle. Those are specific patterns that make up a trend. When those patterns change, that's a reversal. And so when we're looking for reversals, it's a matter of looking for weakness in the pattern. It's a matter of looking for changes in the behavior at certain key price points. And this gives us telltale signs of where the market wants to punch. And so to understand reversals, it's really helpful to first understand just the normal price cycle within a bullish uptrend, the normal price cycle within a bearish downtrend. And so when you're looking at a normal price cycle, you're simply looking at a market that gets oversold. You start to see buyers come in. It creates the next higher level of resistance. And we just repeat this cycle up, down, up, down. In a more simplified version, we simply call it the higher high, higher low. And so the market establishes a higher level of resistance. It then comes back down into the higher level of support. This pattern repeats itself until it doesn't. And then once again, when it doesn't, that should tell us something. Because when you think about this trend, what happens at resistance? Every single time, you cannot have a bullish uptrend unless resistance breaks. Every single time in a bullish uptrend, resistance breaks. It breaks, it breaks, it breaks. That's what establishes the higher level of resistance, is those buyers pushing it higher and higher and higher and higher, and then it retraces back down, establishes that higher level of support. That's the pattern. What is it? Resistance breaks. When resistance breaks, it establishes that higher high, higher low, higher high, higher low, and the trader's going to attach themselves to that trend as long as it is consistent. I don't care if it's 1 wave, 2 waves, 5 waves, 10 waves, or 35. It really doesn't matter. As long as that trend is consistent, those traders are going to attach themselves to that pattern. Well, what if it does hold? And all of a sudden now you see this number and you did see that. Once resistance holds, that tells you something. It tells you that the pattern in the market is changing. How the participants viewed that information at this resistance level was different than that resistance level, was different than that resistance level. The behavior of the buyers is changing. And if the behaviors of the buyers are changing, regardless of whatever the reason is, resistance held, and now we have a different pattern. And in terms of reversal analysis, you don't necessarily know yet, because you have continuation patterns and you have reversal patterns, and they're both very similar while you're going through the process. And that's what I want to focus on tonight, is that process, because it's not just a matter of resistance holding. It's not just a matter of support holding. It's a matter of what happens next, what happens after resistance holds, what happens after support holds. That's where it comes into reversal analysis. And so when we're looking at that bullish uptrend, it's a matter of identifying when the pattern breaks. When the pattern breaks, we need to adapt to the new trend. We need to adapt to the new information coming into the market. When you're looking at a bearish downtrend, it's the same process. You have the same trend, you have the same pattern. The only difference is you flip that chart upside down, and now you got a bearish downtrend. You got lower lows, lower highs. That's the wave. Lower lows, lower highs. Lower lows, lower highs. That's the pattern. You just simply see this pattern, lower lows, lower highs, lower lows, lower highs. Well, from the simplified version, what do we got? Lower low, lower high, lower low, lower high. And so once again, what's the pattern? Obviously, it's a lower low, lower high. But what creates the pattern? What creates the pattern is the violation of support. What happens every time we get into that support level? It breaks. Every time we get into that support level, it breaks. And so once again, an opposite side of the equation, but it's a very similar conversation. What happens if all of a sudden support holds? Does that tell us something? Is the market screaming at us for something? It's telling us once again that at support, the key level where decisions are really made, where decisions are made to buy and sell, is support, is resistance. And so when those decisions are being made, the market participants, wherever they're at from around the world, are behaving around that price point with that information differently than they have been throughout the continuation of the trend. That's the reversal. And so it's these telltale signs in the story of the buyers and sellers, that eternal battle, that eternal story that never ends. It's the war and peace of the market that legitimately never has an end date. It's that story of technical analysis between buyers and sellers, supply and demand, the bulls and the bears, how they behave at certain price points. They tell us something. I always say this in the halftime report. For those of you who are watching Tackle Trade New for the first time, we do the halftime report every single day at about 12:30 p.m. Eastern Standard Time. And every day I always talk about, okay, what's the pattern in the market? Did it break something? Did it change something? Where are we looking at? How is the market behaving at different price points? We're going through earnings season right now. And one of my personal philosophies on earnings season is I felt like we were going to see a better than expected earnings season. Partly in that was not just everybody and their dog screaming the end of the world is happening in the marketplace. That's not it. It wasn't just a contrarian analysis. It's the philosophy that the market behaves on earnings differently if the market's at a high point in the cycle versus if the market's at a low point in the cycle. You see these patterns happen all the time in the marketplace. And so when they break, they tell us something. And once again, when these patterns break in a trend, they tell us something. Does it tell us it's the end of the trend? I don't know. That's where you have to go through the process. And so let's focus on what those key patterns that develop in reversals. And we have three categorizations of reversal patterns. When you're looking at the type of reversal patterns that are more traditional in the marketplace, you have and once again, for every bullish pattern, you have a bearish pattern. Bullish reversals happen at the bottom of charts. Bearish reversal patterns happen at the top of charts. When you're looking at the two most popular, what I would describe as the most popular and probably the easiest to identify in the marketplace, and quite frankly, it's the one we're going through right now as well in the market, is the W and the M formation. The W formation looks like a W. It's the simple holding of support. It's a very simple, it's clean. We love our W formations because it comes into support, it establishes a lower level of resistance, and then support holds for the first time. You dive back up into resistance right there, and you see that W formation. With support holding, it works its way back into resistance. The pattern has significantly changed. Once it breaks out, you have a bullish uptrend. You can doubt it, you can deny it, but it doesn't change the fact that it's a bullish uptrend at this point. Once you break out of resistance, you cannot deny that. It breaks out, it was resistance. What was resistance is now support. You got to be looking at higher prices in that capacity. Well, on the flip side, you have what is called the M formation. The M formation stands for murder. Most bearish formations in the market have a negative connotation to them. Most bullish formations have a positive connotation to them because most traders, most investors are bullish. There's a minority in the bearishness. And so when you're looking at those M formations, those death crosses, the kiss of death, these are all bearish formations, whereas you have the golden cross, the kiss of low, these types of more positive winner, winner, chicken dinner for the W formation. It's just a name. That's all it is. But, someone had to give it a name. And so the M formation is the simple holding of resistance. It works its way back into support. And then once you violate support right there, you have a new bearish downtrend. Once again, we can deny it. Doesn't change the fact that we're seeing it right there in front of our very eyes. And so you have the standard W and the standard M. Those are probably the two most popular and quite frankly, probably the two most active in the market that we typically see. They're the easiest to identify because you have a historical support level that has now held a historical support level. It worked its way back up into a historical resistance level. It's pretty easy to identify, a little bit harder to trade, but it is pretty easy to identify both the W and the M formation. Now, the second type of formation you have is what is called a head and shoulders formation. A head and shoulders formation, you see my left shoulder, my head, my right shoulder. Well, we'd like to draw those things from a technical perspective as well. When you're looking at the inverted head and shoulders, it is a bullish reversal formation, whereas you have the establishment of a bearish downtrend. Let me get my epic pen out here. You have the establishment of a lower level of support, a lower level of resistance. You then have another lower level of support. That up until this point is nothing but a bearish downtrend with a little bit of slowing momentum. Now, because of the slowing momentum, it might be on our radar for potential reversal. You hear me talk about that quite a bit. Well, we're going through a little bit of changing volatility. We're going through a little bit of slowing momentum. Can that lead into a reversal? The reason I say that all the time is because slowing momentum is a precursor. It is one of the first things we typically identify when we go through reversal analysis. Think about it like this. We all know how a stoplight works, right? You got green, go, 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 go. That's just the bullish uptrend. Higher highs, higher lows, higher highs, higher lows. The light's green, go, 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 go. Light turns yellow. What do? Tap on those brakes a little bit, unless you're in Utah or Texas, then you go forward. But typically, you tap on the brakes just a tiny bit, right? You slow down. That's that slowing momentum because we're expecting to stop. We're expecting to stop the car, the vehicle, the truck, whatever we're driving. And so when you see that slowing momentum, as we're seeing right here, that's just a little bit of a caution flag, a little bit of a yellow light saying, caution, there's a little bit of slowing momentum here. Maybe we're going to get into some reversal analysis. And then in the head and shoulders, what I love about it is the depth of the retracement. And that's another thing you hear me talk about all the time, the depth of the retracement. You see the slowing momentum here in the inverted head and shoulders. The retracement works all the way back. And it can come into here, it can come into there, but you typically see a little bit of a deeper retracement so that when the next time we see a sell-off, it creates a higher level of support. Now, that higher level of support at this point is not bullish yet because you don't have that breakout. Remember, you got to break something to change something. And so in terms of that breakout occurs once it breaks what is called the neckline. Once it breaks resistance, at that point, you have confirmation on the head and shoulders. It's not the increase in support because you're still within the overall neutral trend. It's when it breaks out and you have firmly established a higher level of resistance that you now have that bullish confirmation. That is the head and shoulders formation. When you're looking at the inverted head and shoulders, when you're looking at the head and shoulders, it's just polar opposite. It happens at the top end of a chart after a bullish cycle. We see that left shoulder come into the market. Let me get my epic pen again. You get that left shoulder establishes a higher level of resistance. The retracement works a little bit deeper down, and then all of a sudden we establish that lower level of resistance, establishing that sellers now have control. Once sellers have control, once you violate that support right there, you now have that continuation of the bearish downtrend. Again, it's tempting to play within the reversal. I say tempting. You shouldn't do it. It's tempting because you see that level of resistance for the first time. You're like, ooh, this is going to go down. This is going to go down. This is going to go down. Maybe, maybe, but only if it breaks support. Remember, to change something, you have to break something. That's the rule here. In reversal analysis, you got to break something. You got to see that final confirmation because we're splitting hairs, guys. We don't need to nail the top price. We don't need to nail the bottom price. We can be patient as it works out its technical demons to a certain extent, as it works out the direction it wants to go. It can go up and down and up and down. It could take a month. It can take a day. We don't know the time frame. We don't know what the news cycle is going to be. What we do know is that the buyers were not there. We do know that the sellers sold at a lower price point, and we do know that stop losses like to be placed under support. And so if we know all of those things, let's just wait for the breakdown where those stop losses get hit. We attach ourselves to the momentum to the downside. And so that is the overall pattern of what we label the head and shoulders. The other pattern that is similar to a head and shoulders that became popular during the early stages of the pandemic, and because of the way algorithms do work and how much impact they have on the day-to-day price fluctuations in the stock market, they are still popular today, even though I would say they've lost a little bit of their popularity over the overall buy the dip mentality in 2022 hasn't exactly been very, very strong. And so when you do look at the 1-2-3 pattern, I want you to think of the 1-2-3 pattern as a reversal without a head and shoulders without the left shoulder. That's what I want you to think about it. The momentum can be whatever it wants, and this is the challenging condition. The momentum can be truly whatever it wants. I do not see in 1-2-3 V-shaped reversals, ladies and gentlemen, I oftentimes do not see slowing momentum before they occur. They usually occur on some type of news-based event, some type of overall market event, some major news coming into the market, an earnings report. Like we're going through earnings season right now. We're dealing with a lot of stocks at the low price. What happens if those stocks have positive earnings, gap up, and then sell back down? Well, that's going to be a 1-2-3 reversal in the sense that you gap up, you come right back down, establish a higher level of support, and what do? That's that secondary pattern that we like to look at. You get that confirmed, we're back up off to the races. And so the 1-2-3 pattern is very similar to the head and shoulders without the left shoulder. It is that news-based event that changes the dynamic of the trend immediately. New information came into the market, we got to price it in immediately. Earnings came out, we got to price it in immediately. All of a sudden, there's peace in Ukraine and Russia. We got to price it in immediately. All of a sudden, the Fed announces the pivot. We got to price it in immediately. There's a lot of different scenarios that could emerge to create what people would often consider the V shape, but what I would consider as a 1-2-3 formation. It's just, again, it's a catalyst-driven pattern. Is my point, that can come out of nowhere. The hallmark that we're looking for, though, is not simply because it goes up. The hallmark we're looking for is two things, and these are very, very important. Number one, I'm sure you guys have heard me say it a little bit, the depth of the retracement. Deeper retracements are very powerful in 1-2-3 analysis. Things that break back up above the 9 EMA, back up above the downward moving 20 SMA. Things that can, in terms of the retracement, and the retracement would be this right here. This is the retracement I'm speaking of. And so that retracement works deep, 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 typically into at least a 20-period moving average, perhaps even a 50-period moving average on the daily chart. You work into your deep retracement analysis, 61% on the fib, 50% on the fib, something along those lines. And that gives you a little bit of room to play with to the downside, because you know that news is going to come out. where it's going to bring all the market down for 2 to 3, 4 days. It's going to bring all the market down. Well, if you're working from a little bit of an elevated retracement level, that has room to come down without violating that previous support level. And so you're looking for a deeper retracement, number one. And then number two, that works down until you get into a higher level of support. Once you increase that level of support, this is what we call bear stop out day, by the way. And so 1, 2, 3 patterns, V-shaped recovery patterns, we also nicknamed the bear stop out day because that's the trigger on the confirmation for the 1, 2, 3 trend. And so whenever you hear us say bear stop out, and maybe not whenever, because we can be a little loose with that sometimes. But whenever you do hear that bear stop out, there is some conjunction of a 1, 2, 3 type pattern happening, and they can be extremely powerful momentum-based patterns. And so traditionally speaking, we like M's, we like head and shoulders from the bearish reversal. We like W's and inverted head and shoulders from the bullish reversal. But every now and then we will be able to identify that momentum-based 1, 2, 3 pattern off a catalyst. And again, don't know what the catalyst could be. It could be anything. But once you identify it, that bear stop out day creates a powerful momentum pattern. And so when you're looking at the 1, 2, 3 on the downside, same type of conversation, could be any catalyst. You work into a deeper retracement, which allows that next upward drift to establish a lower level of resistance. That's lower level of resistance. Well, it's not the lower level of resistance. It's the depth of the retracement that puts it on the radar. The lower the level of the resistance level confirms that it's firmly entrenched in reversal analysis. And then immediately upon breaking support, that is at that point the confirmation of a bearish downtrend. And so once again, the beautiful thing about the reversal analysis is as long as we can identify where support, where resistance levels are, what the momentum of the market is doing, we can kind of discount the news cycle to a certain extent and really just focus on the price action because Mark Twain might not have said that, but I certainly have a time or two. Price action is the absolute truth of the marketplace. When you think about the process of a reversal, it's not a day. To have a reversal, like for example, to have an M formation, you have to have 4 pivots in an M formation. 4. To have a head and shoulders, you have to have about 5 or 6. Even in a 1, 2, 3 bear stop out victory formation on a reversal, you have to have at least 3 pivots. Pivots take time. You can't have a pivot in the market simply because one day the market goes up and the next day it goes down. We just call that volatility here at Tackle Trading. There's no clear direction in the marketplace. We like the number 3. You got to have a 3-day movement, 3-bar movement. I shouldn't say day because day traders will focus on 5-minute charts, for example. Swing will focus on 60-minute charts or daily charts. Position traders might focus on weekly charts. So it's more about those 3 candles, those 3 bars. You have to have a certain minimum standard of both time and distance in terms of assessing what a pivot is. Because if your standard of a pivot was, if it goes up one day, that's a pivot. Well, on this chart you're looking at, there's about 14,000 different pivots. And so the minimum standard we like to look for is that 3. We like to look at 3 candles, 3 bars, 3 time frames to have a pivot in the marketplace. And a pivot is just a change in direction, right? Was going down, it pivots goes up. Was going up, pivots coming back down. And so it's just a change in direction. My point is this. If a reversal has to have 3, 4, 5, 6 pivots in it, and pivots take a minimum of 3 days to create a pivot, then typically reversals will take about a month of time frame. It's not short term. Now I'm talking daily charts there. Obviously, on an intraday chart, it can be done in, if you're looking at a 1-minute chart, it can be done in literally 10 minutes. That's how fast it could be. You're looking at a monthly chart, that's a lot of time frame. And so obviously I'm talking in terms of that time frame would be on the daily chart. Now, daily reversals can lead into weekly reversals, and weekly reversals can lead into the ultimate bottom of the market, which is, I think, the number one thing we're all trying to figure out. Would you guys agree with that, by the way, Team Tackle? The number one thing we're trying to all figure out in this marketplace right now, is this the bottom? or where is that bottom going to come in? When do we push those chips into the middle? When do we buy those amazing stocks? When do we buy that stock with a 5 PE ratio in this economic condition, right? That's the game here, right? The game, it's not when the market's already down 30%, guys, the game isn't, hey, let me go see how I can nickel out the last 3% to the downside, or the last 5% to the downside, or the last 7% to the downside. Not when you're thinking about the next 10 years in the next bullish cycle. And so, and by the way, that cycle will not officially begin until we get a Fed pause that could lead into a pivot, but that's a halftime report conversation. Now, the 5-step process, the dance of the reversal, the art of the reversal, that can help us understand where we're at in making that ultimate decision. Is this the bottom on XYZ stock? Is this the bottom on XYZ sector? And ultimately, is this the bottom on the actual stock market, right? That's what we're trying to figure out. So when it comes to the dance of the art of the reversal, there's 5 stages to it. We're looking at a bearish reversal right now, an M formation. You see the M formation right here. You see the violation of support right there. And so we're looking at an M formation. What are those 5 steps? Well, the first step we like to look at, ladies and gentlemen, is we like to look at what's called slowing momentum. Slowing momentum can be done in a couple of different ways. You can look at it from a visual perspective, identifying your levels of resistance. You can do it from a wave counting perspective. I'll talk about slowing momentum here in just 1 second. When you look at the double top is the official end of the trend. You don't know if the next trend is bullish or bearish. All you know is that the previous trend is over. That's it. That's all you know at this point. You do not know anything other than that. You know the previous trend is over. You do not know the direction of the next trend, because up until this point, all you have is resistance holding. You don't know what's going to happen with support. If support increases against the previous support level, I promise you technicians is going to be projecting higher. I promise you Goldman Sachs traders are going to be projecting higher, because simply because resistance holds, it doesn't mean that the sellers have control. If support increases, buyers still have control. And so you just know you're at the end of the previous trend. That's all you know at this point. What about the next point? The next point in the reversal is what happens with support. Support is hit, not violated, but hit. And the reason that's important is in a bullish uptrend, you have higher high, higher low. Now that you have resistance holding and support holding, you have no higher high, higher low. You have no lower low, lower high. You have no trend in any capacity. There's no projection here. There's no, ooh, that's going to go up, or ooh, that's going to go down. There's a, what next? Well, what's next is you got to break something. To change something, you got to break something. And so what do you have to break here? You got to break support. You got to break support. Once you break support, at this point, you are firmly entrenched in a bearish downtrend. You have to respect that price action. You cannot deny it. You cannot look at that candle, a big red candle violating support, and say, nah, it's going to come back up. Because you're right, it will. It will come back up, and it will fool you, and you will think it's okay, but it's not. It's the calm before the storm to a certain extent. It will come back up, because what it does is it comes back up, forming that next lower level of resistance, because you're now firmly entrenched in a bearish downtrend. And now you form what is called the kiss of death. And the kiss of death is that last pattern within a reversal that ultimately triggers that next downfall. And so when you're looking at the process here, we first identify momentum. The second thing we identify is the double top, double bottom. The third thing we identify after the double top, double bottom is we wait for it to break something, because you got to break something, right? You got to break something. You break support, you see that volatility to the downside, you are now firmly entrenched into that bearish downtrend. Now, if I take this chart, take a look at this chart right here. Remember, all forms of bearish technical analysis, it's honestly, it's 2-part. Part number 1, flip that chart upside down, add a dose of volatility to it, and you now have a bearish downtrend, because fear is a little bit more powerful than greed. But the reality is, that's all it is. You just flip that chart upside down and you have bearish downtrend. You have bearish analysis. For every bullish trend, you have an equal bearish trend. For every bullish pattern, you have a bearish pattern. For every bullish candle, you have a bearish candle. Every single degree of bullish technical analysis has an opposite bearish analysis, every single one. And so when you're looking at this chart, and all I did here is flip this chart upside down to show you the polar opposite of the bullish reversal, because I don't think it does anybody justice to talk about bearish reversals in this market right now. I don't. Why? Because the S&P is down 21%. The ARK index is down, I think, 14,000%. Growth areas of the market are down 80%. I think we're through the bearish reversal analysis, quite frankly. If we see another leg down, it's more of a continuation than anything. So it doesn't do us any justice to be like, ooh, we got all these bearish reversals happening right now. No. Those happened. Those happened. They were happening for the last 6 months. I wanted to see if anybody would catch that, Matthew. I know I told Christian, because Christian is, you guys know Christian. I was like, Christian, there's only 2 candles on this chart, because it was Christian's idea to be like, hey, let me just flip that chart upside down, because that's all I ever talk about. I'm like, all right, just flip the chart upside down. You're fine. And I said, Christian, I hate those 2 big red candles. They just give the different visual, don't they, Matthew? Yeah, I believe me, I had the exact same thought. But I love the power of the show here, because I love the fact that you can look at the bearish side of the equation in the same capacity you look at the bullish side, because that's how it should be done, right? We shouldn't be looking at the bearish reversal any different than we were looking at the bullish reversal. It's just price action. That's all it is. It's the market behaving at support differently than it did at resistance, the same way it happens on the bullish side or the bearish side of the equation. So what are those processes? Step 1. We don't have to, because you got the 1, 2, 3 pattern, but typically we see slowing momentum. Typically you see slowing momentum occur. And then you have the double bottom, and then you have the double top, and then you have the violation of resistance. Once again, to change something, you have to do what? You have to break something. And so you got to break out of resistance. Once you break out of resistance, you now have a nice little bullish uptrend. Well, what's step 5? Step 5 is not the kiss goodbye. It's supposed to read kiss hello, by the way, Christian. But it's not the kiss. It's not the kiss of death. That's my language, is the kiss of death. But it's the kiss hello. And when you see that kiss hello right here, which is the first retracement following a reversal, that is perhaps the most powerful buying opportunity in any market cycle, ladies and gentlemen, in any market cycle. And so when you're looking at this process here, the first step is to look at momentum. Momentum is, if there's one thing technically that is more important than support and understanding the concept of support in the market, I'm not sure what it is. But momentum would be a close second to me. Resistance and momentum. Momentum, things, and it goes back to that concept of things in motion have a tendency to stay in motion until an object appears that stops the motion. And so momentum, when you identify momentum's in motion, you don't question it. It's like questioning a runaway freight train and thinking you can get in front of it to stop it. It's not going to happen. I don't like your chances. I like the freight train's chances. You never question the momentum. You just, if you like the company, you like the stock, you just attach yourself to it. You bar by bar it. You look for that next momentum pattern, whether it's a high base or whether it's a bull flag or a standard retracement. You're just looking at it in that capacity. And so you never question the momentum. Now, when it comes to increasing momentum, you can look at this in 2 different ways. The first way you can look at momentum is from the resistance levels. How far did resistance upon the breakout run? That's a very popular technique in identifying the current momentum of a stock. And so when you're looking at these breakout channels here, you have a resistance level right here, and you have a resistance level right there. Well, once you break out of the resistance level, what happens? You establish that next level of resistance. The market moved up $3. Well, once you broke out of this resistance level here and you ran up to that next level of resistance, what happened? The market ran up $8. And so you have an increasing momentum condition here. It runs 3, then it runs 8. And so do we question that? No. You wait for that next pattern, you trade that next pattern. Your projection is always higher high, higher low until you see any weakness in this trend. And the first weakness we're going to see in the trend, well, what is it? The first weakness we're going to see in the trend is if we see slowing momentum. Give me 1 second, guys. I'll be right back. Just got some BuzzFeed in my ear. Thank you, Matthew. I appreciate that. Now, when we're looking at, again, the momentum, you look at the resistance levels. That's one technique, and I do like that technique. I really, really like that technique. The other technique I also like, though, is to look at what's called the wave count. And what I'm talking about in the wave count, and I don't have it on this screen here, so I apologize for that, but I'm looking at it from support, not necessarily simply from the breakout, but I'm looking at the wave from support to resistance. Then I look at the second wave from support to resistance. And if you see the wave expanding, that also shows you increasing momentum. And so there's 2 ways that you can identify momentum. The first is from the resistance breakout to the next level of resistance. And the second way is from the wave count, the momentum from support to resistance. That's what we're looking at in terms of the momentum of the marketplace. Now, when you're looking at bearish momentum, same concept. You can look at the support breaks. You break support, you drive down 3 points. You break support, you drive down 5 points. You break support, you drive down 7 points. You have increasing momentum. You have increasing momentum. Think about, like I was talking about the runaway freight train, right? You have a freight train, runaway freight train situation. It's going 20 miles an hour. It might stop. Now it's going 30. I don't like it. It's not going to stop. Now it's going 60 around a corner. Not going to stop. Okay. So it's that momentum that just simply continues and carries over in the continuation of the trend. The probability of the trend continuing is extremely powerful in this environment. Well, the opposite of increasing momentum is just that, decreasing momentum. When we look at decreasing momentum, you can see it visually because what happens is it starts looking like a U shape. You can see it right here. It starts looking like a little bit of a U shape, a little bit of a rounding bell curve to a certain extent. Well, what's creating that U-shaped turnaround is momentum. You see it drive up 4 points, then it drives up 2 points, then it drives up 0.5. You see that momentum shifting. Buyers are not treating the breakout the same way. Buyers aren't having the confidence in the breakout the same way. The market isn't giving the time for them. There isn't enough time for the market before you see something else happen for it to firmly establish that next bullish uptrend. And so you see certain telltale signs that are showing you that this trend is getting weaker. And that's the precursor to the reversal. It's the decreasing momentum. You see it through the resistance levels in a bullish uptrend, and in a bearish downtrend, you see it in the slowing momentum of that trend. And so what I want to do is I want to go into the market, guys. And I want to talk about some of the current reversals that are happening in the marketplace. And I was thinking about the topic of tonight's Tackle Trading 101 series. And I was thinking about doing RSI, and I was thinking about doing an indicator, and I was thinking about doing, moving averages or some technical conversation, because I love having technical conversations. And that's what Tackle Trading 101 series is all about, is bringing awesome educational trading concepts to our YouTube community and our pro member community over there at Tackle Trading. And we always like to be relevant towards what is happening in the marketplace. And right now, over the last 3 to 4 weeks, we're going through a reversal. Now, it's only a short-term reversal, but we're absolutely going through a reversal. You can't deny it. You can question it. Certainly, I question it. I think you would be foolish not to have some doubt in this marketplace. I still have that ultimate question of, well, what's that next leg to drop? We haven't seen any corporate bankruptcies yet of anything to note. What's that next leg to drop? But we're always going to have a little bit of concern in these environments because, again, think about what we're seeing in our world. We're seeing a horrific economic analysis out there. We're seeing horrific inflationary analysis out there. And so it's sometimes hard just to treat this technically. I think the journey in terms of understanding a lot of this is just trusting the technical setup and kind of taking what we think and putting it over here on the shelf and just focusing on what we can identify. And so I think it would be foolish to not have a little bit in us that says, man, it could get painful out there. Yeah, it could. It could. You're right. No doubt. But is it happening right now? Is that what's happening right this very second? No, it's not. Why? Doesn't matter. No. That's the thing, is we're always going to have those overriding concerns up here, but we got to trust our eyes. We got to trust our eyes. And so once again, because what we read in the news, okay, what we read in the news is happening today. But what's the market thinking about? What's the 12-month forward PE ratio doing after a week of earnings reports? What's the forward projection of guidance read? What's the Fed projecting 6 to 12 months out from now? That's what the market is actually thinking about. What you and I might be thinking about, what did we just read on CNBC? What just happened to our stock today? That's what we might be thinking about. But what's the market thinking about? Market's never wrong. Never wrong. It's just not. Market's never wrong. Market's right. We're wrong. Okay. And so we are going through reversals right now. We have some hesitation in the back of our mind because we're going through a short-term reversal. But here's the kicker. A short-term reversal on a daily chart can absolutely lead into a longer-term reversal on the monthly chart, on the weekly chart. And so what I want to do is I want to take a look at some of these reversals in the marketplace. And I want to talk about them from a technical perspective. What's happening at support? What's happening at resistance? Is there an opportunity? And so let's take a look at this. And earlier today, guys, I was doing a little tackle 25. It's that time of the year for me. It's we're getting into mid-October. My month of December is pretty much tackle 25 driven. I start doing all of the analysis really, quite frankly, right now, because this is the last earnings season we have before I do the next edition of the tackle 25. Now I got a couple stats for you guys. Market's been nasty this year, hasn't it? It's been just a nasty market this year. The tackle 25 is down 15% this year collectively. If you average out the tackle 25, it's down 15%. It's beating the market by about 6%. And that's without the cash flow. That's without the dividend. That's without everything else people do on the tackle 25. Just from a directional perspective, the tackle 25 is yet again, and I do say yet again, beating the S&P 500 because that's the name of the game, beating the S&P 500. There's been some dogs there. No doubt about that. There's some dogs. You want to see a dog? Oh, man. You want to see the biggest dog on the tackle 25 this year? Taiwan Semiconductor. And it is a fantastic company, but it's the biggest dog on the tackle 25 this year. It's down 49% year to date. The biggest winner on the tackle 25 so far, shocker, Devon Energy up 72% year to date. When you're looking at some of these potential reversals, I wanted to look at stocks that I like. If the market reverses, guys, a lot is going to reverse in the market because the market's going to carry up even the trash. If that rising tide goes up, guess what? The boats go up, all the good ones, all the bad boats go up too, and all the trash goes up as well. And so if this market reverses, even in the short term, it will carry even trash back up. Tackle 25 ain't trash. Tackle 25 is the best 25 stocks for cover calls in the marketplace. And so I wanted to look at a couple of these components, but I first want to look at the actual marketplace itself. When we're looking at the S&P 500 right now, can you spot the reversal? Just yes or no. Let me know in chat. When you're looking at the reversal, right, or not the reversal, but when you're looking at the S&P, can you see the reversal happening right before our very eyes? Yes. Now, one thing I have not talked about yet is I have not talked about origination points. Reversal analysis doesn't happen in a box. Reversal analysis doesn't happen out of nowhere typically. Remember, in standard reversal analysis, we got W's, we got head and shoulders formations, and we got the 1, 2, 3 victory formation. It's only the 1, 2, 3 victory formation that comes out of nowhere. That's the only one because it's usually driven by a catalyst. The other reversals don't happen out of nowhere typically. Typically, we see something on a longer term situation that creates the opportunity on the short term timeframes. And so this is a concept that we at Tackle Trading teach from and quite frankly preach from at this point, origination points. It's in the hard 14. It's a Coach Mark concept. And shout out to the Skull Vikings out there. He was talking about the Vikings trading lab earlier today, but it is a Coach Mark original origination points. On the long-term time frames, there's certain moving averages that stand out, just absolutely stand out. I was watching CNBC this morning, and there's a technician on there that I have a lot of, I just have a lot of respect for. His name's Swin. And he was talking, CNBC was showing all these random charts, and it was so funny because he just kept talking about the 200 weekly, and they didn't have it on there. And he just kept talking about the 200 weekly because it's that important. And yet they were looking at all these other charts like, no, it's just on the 200 weekly. That 200 weekly stands out because it's not just us at Tackle that looks at it. It's every other technician out there, hedge funds, institutions. It is one of those areas on the chart that decisions are going to be made. No doubt about that. And when you have an area on a chart where decisions are going to be made, you're either going to see a really good short, or you're going to, when that decision fails, or you're going to see a reversal. It's those decision points. And that's what an origination point is. It's those areas on the chart where you know decisions are going to be made from a bullish perspective or a bearish perspective. And so it doesn't surprise me, and I don't think it surprises a lot of people out there, that we're seeing a little bit of bullishness and a little bit in what I would honestly consider more stabilization than bullishness at this key level of support. And so when you're looking at where these reversals can happen, again, trust that they just aren't random. There's a lot of times when people think they're random, it's because they're looking at a daily chart and they're only looking at 6 months of data, and they're like, it's out of nowhere. There's nothing else there. The only thing in this market goes back 6 months ago. No, it goes back to 1798. That's when it goes back to, okay? But that's why people make that mistake, is they just get so fixated on the daily chart that they kind of miss the forest through the trees. And so when you're looking at this, understand that oftentimes when we see reversals, they happen because we've found some origination point where a majority of traders and investors are going to make decisions. And that absolutely, one of those key areas is absolutely the 200 weekly moving average. And so that 200 weekly moving average is legitimately right there, right underneath our current price level. And so when you're looking at this type of situation, you currently are going through, and this is one of the reasons why I said the depth of the retracement matters here, is because ultimately you're going to see that next selling behavior. Ultimately, there's going to be a news story that triggers a bunch of panic selling. Does that panic selling continue through a support level? If it does, you can see a lot of craziness. And so we had one of those days, quite frankly, right here on the green wick. But because of this retracement being a little bit deeper, you work your way back down into support. You hold your support level, you work back up into resistance. That's the current reversal that we're seeing on a daily chart. Now, can that daily chart reversal, can that trigger a longer term reversal? The answer is yes. And the answer, and also the one thing nobody likes to hear, but it's actually the truth, it also depends. But you can't have a longer term reversal unless you start seeing these first. We saw one over here. We saw one over here. We're seeing another one here. Ultimately, it's going to lead into that. What's the key difference? The origination point. That's the difference today versus this pivot point versus that pivot point. You have the 200 weekly underneath this level. That is the key difference. Now, have we broke resistance? Not yet. Not yet. And so we're currently in the step 3 versus 4 of the short-term reversal in the S&P 500 right now. Now, if you want to understand a little bit of what I'm talking about in terms of that short-term reversal leading into a longer-term reversal, let's go to tackle 25 component DFS here. And let's look at Discover Financial Services. And let me take off the lines here. Can you see the short-term reversal that is happening in the last month? Okay, and just give me a yes or no in chat, and I'll draw it here. You got a bearish downtrend, comes down, establishes a lower level of support, retraces back up, drills that 20-period moving average, comes back down, works its way back up. You can see that W, right? Okay. Is it the same W that we're also seeing in the S&P 500? Yes, it is, which means Discover's very reliant on the S&P right now. You're seeing the same thing. So why am I using it as an example? If you're seeing the exact same thing. You know, Vanessa, I think I need to do a step system mastermind on retracements because Vanessa, I can't do it without teaching Elliott wave. So does anybody, any pro member out there want an Elliott wave, Fibonacci, depth of the retracement webinar in the step system next month? If you do, type yes in chat. I'll do it. I'll plan it. Jay, smooth. Kevin, I can't say no to Kevin. Of course, Kevin. Maybe twice. That's why I record it, Matthew. By the way, Greg's going to be taking over the step system about 8:30 p.m. Eastern Standard Time today. So Coach Greg's going to be in the step system tonight. I'll be in the step system next month, and we'll do just that. Okay. Nobody says no to Kevin. Like literally, who can say no to Kevin? All right. But the reason I bring up DFS, guys, is because when you're looking at this short-term reversal in conjunction with the longer-term analysis, you see something a little bit differently. And so what I'm going to do is I'm going to drive this back out to a weekly chart, and we're going to talk about this reversal. You can't call a market bottom on a daily chart, in my opinion. Ultimately, the bottom comes in on a 1-minute chart. Nobody catches that one. That's all algorithms. And it goes to a 2-minute chart, 3-minute chart, 5-minute chart, 10-minute chart, so on and so forth, all the way up to the monthly chart, or excuse me, quarterly chart. It's the weekly reversals that are ultimately market bottoms. When you're looking at macro analysis, you got to be living on a weekly chart. When you're talking about market bottoms, you got to be living on a weekly chart. When you're talking about market tops, you got to be talking about them on a weekly chart. The daily chart, we like to analyze, no doubt, probably a vast majority of the time, because that's where all the price action is. That's where all the activity is. That's where all the action is. It's the daily chart reversal coupled with the weekly chart that you really can see a bottom here. I don't know if the S&P is going to be a bottom. I don't even know if Discover is going to be a bottom. What I do know is we're starting to see the hallmarks of that. You won't know if it's a market bottom till at least you start breaking out of some weekly resistance levels. We get a Fed pause. You get a little bit of further down the road economically. You never know that. You got to make tough decisions in the moment. But what's different about this chart versus some of the other ones? Well, this right here, $90. This little short-term support level is now a double bottom on the weekly chart. And so we have this wick bottom coincided with all this wickety wick analysis over here that solidifies that as a double bottom. And so you have a short-term reversal happening on Discover, coupled with a multiple time frame support level where we're seeing that reversal take hold with a foundation of support called the 200 weekly moving average underneath that. Discover's one of those situations where you're starting to see that double bottom take hold on the weekly chart, and you're starting to see that daily chart start to show a little bit more love here. And so you could definitely see a strong reversal. So Discover certainly would be a strong reversal candidate, given the fact that financial companies are starting to punch up a little bit more aggressively. The cyclical areas of the market are starting to come online a little bit more than some of the other areas of the market, especially when you're talking about finance and industrial. Basic material maybe follows suit. Energy obviously has been king, queen, and country for us at Tackle Trading for a very, very long time. But in terms of Discover, we're talking about low price here. And that's without talking about the quality nature of the fundamental analysis behind many of these stocks on the Tackle 25. And that's something I'm not going to geek out on right now, but I will tell you Discover has a 6 PE ratio, while it is also going through a really consistent short-term bullish reversal tied to the S&P and a little bit of a longer-term bullish reversal when you look at that weekly chart as well. Let me take a look at another one. I'm going to take a look at some short-term reversals. Then we're going to cross compare against some of the long-term ones as well. Let's take a look at Mosaic here. Mosaic here, a nice little consumer staple based company, little food action here. How many of you can spot the double bottom? We just talked about it. Remember, you got a double bottom. We have a double top. You have a W formation. Everybody see that? Good. We got the short-term reversal happening here, right? We got the short-term reversal happening here. And so we're definitely tracking that reversal coming out of Mosaic. Is there multiple time frame analysis? Yes. Not only do you have a short-term reversal happening on the daily chart, but looky, not my favorite pattern, by the way. That won't shock anybody at Tackle Trading. But old Coach Frank would love this. Think about it. On Mosaic, a company that has not gotten beat up this year like everything else in the market. It's not an aggressive, high-flying tech stock. We're talking about Mosaic, for crying out loud. You have a short-term reversal happening right now that is an increase in support level on the weekly chart, creating a symmetrical triangle that, if the symmetrical triangle gets broken, typically sees explosive volatility to the side that it gets broken. That leads me to look at Mosaic a little bit more closely as it is navigating a little bit of this short-term chop between the 50 here and the 200 there. And so I ultimately would say above 55 is ultimate confirmation here, breaking out of both the reversal, reclaiming the 200 period moving average, but also breaking that weekly symmetrical triangle. I think what I hope you're understanding here is it's not just the daily reversal that we're really looking at. In the back of our mind, we're always thinking about that longer term chart as well, because again, we're trying to answer some really, really, really important questions. And they're not just, oh, let's go make a swing trade for the next 2 to 3 days. That's not what this conversation is about. This conversation is about understanding reversal analysis so that the members of our community can make decisions around their portfolios that's going to impact them for the next 5 to 10 years. That's what this opportunity is in understanding reversal characteristics is more from a longer term perspective than just what a bunch of traders might say on a random day that ends in Y, like that Mosaic setup. No doubt about that. Let's take a look at another one here. Let's look at Ford. Let's look at Ford. Ford's on my mind. Ford's on my mind because, again, we're going through the exact same thing that we went through last quarter. What did we go through last quarter? Double bottom right here at $11. Double bottom worked its way back up into resistance, broke out of resistance, and then had the best. And let me say this again, the best earnings report last season was Ford. I said it in the moment. I said it a week after. I said it a week after that. I said it during this downtrend. I said it when it broke support and it had that negative news day. And I'm going to say it right now, because just because short-term traders push the price where they want to in the short term doesn't change the fundamental nature of a company, doesn't change what they reported right here. And now what you're seeing again, you're seeing that same song and dance routine being played out. Double bottom, slightly north of 11, but a double bottom at 11, working our way back up to 1250. We're coming into earnings. You got that same situation. Can we get a repeat of that? I don't know. But what I do know is this is a wonderful company with a 5 PE ratio that's going through a reversal analysis that is at the same price point that we had last time before we went through that same song and dance on the earnings report just recently. Keep an eye on Ford. Once again, let's go out to the weekly chart. Is there something else there? Is there a reason that we're seeing the price action behave the same way right around $11? What is it about $11? If it was $10, I'd be like, $10. Yeah, $10. It's a significant number. You know, traders are crazy. You know, we can't think past 10 or 20. We have to have these whole numbers. 2 plus 2 is a little hard math. We got to have these whole numbers. But 11, nobody cares about 11. Why does Ford care about 11? It's not 11. Nobody cares about 11. Like, legitimately, nobody. 11 is just a number. It's random. It has nothing. There's no emotional context to it. It's the 200 weekly. That's there. That 200 weekly is an origination point. And if that gets blasted, 10's not going to be the concern. 8's going to be the concern. But that has to break first. And so you're going through that same type of process. Ford's on my radar for another earnings conversation. That's coming up later on this week. Let's take a look at more of an aggressive situation happening here. Micron. Aggressive tech-based company, semiconductor company, has a little bit more of a cyclical type price feel to it than some of the other semiconductors out there do. You're seeing a little bit of a bearish retracement on the weekly chart, but you're seeing a bearish retracement that is a little bit deeper. We like those deep retracements, don't we? A little bit deeper on the backs of some slowing momentum. You see this slowing momentum. We just talked about how to identify slowing momentum on a chart. You look at support to support. That's a bad line. To support, you see that slowing momentum. You see that story change. You see that U shape coming in. Well, let's go to the daily chart and let's see what type of price action we're getting on that daily chart. We know we got slowing momentum on the weekly chart. We know we got a deeper retracement on the weekly chart. Do we got supporting evidence on that daily chart? Oh, well, I think we do here. Look at that 55 handle there. Look at that 55 handle there. Look at that positive earnings report there. Market punched up, hit into 55, consolidated, gave it time for that 50-period moving average to get underneath that, break out of 55 on Friday, maintain the discipline of the pattern here today. Daily price action suggests that we have not only reversed, but we have also confirmed on that daily reversal. Micron on the weekly chart still has a little bit of work to do for an ultimate reversal to occur. A little bit of consolidation following a breakout of that 50 of the 20 weekly. You can easily see that market punching back up to 60 pretty quickly. Keep an eye on Micron. Nice little reversal happening there as well. Let's take a look at another Tackle 25 component here, eBay. eBay, what are we seeing here? We're seeing slowing momentum. Let's look at it a little bit differently this time. You see the momentum there? See that big green candle? That's one candle. That's one candle. Tackle trading knows one candle doesn't mean anything to us. We need minimum standards at tackle trading. One day doesn't mean anything. One bar doesn't mean anything. It's just one bar. That's all it is. Got to have two to confirm something. And so you see this downward movement in price here. It goes from about 57. You can make an argument of 60 actually with that wick, but I'm just going to go to the bodies here right around 57 to about 42, drives about 15 points down. And then you drive from 50 to about 36, about 13 points down. And so you see this right here. You see how this one's bigger than that one there? That's the slowing momentum. So the week chart has slowing momentum. Okay, slowing momentum is just that, slowing momentum. It doesn't mean anything, not without some further evidence. Well, where is that further evidence? Where's that going to come from? Let's go to the daily chart here on eBay. Is the pain too much? Is the pain too much on eBay? I don't know. What we have is a little bit of a short-term W formation. That's all we have right now. We have an earnings coming up in about a week and a half from now. Too much time frame here. I need to see more. The other ones are better. I need to see more. This isn't enough for me in the front of face of that. Need to see more. Coming out to the weekly chart. The weekly chart also tells me I need to see more. I only got slowing momentum and I don't have supporting evidence yet on that daily chart in front of that earnings to make a decision. So eBay, I need more time. And guess what? So do you. Let's look at FCX here. FCX, a little bit of a W formation happening on the weekly chart. Look at this, double bottom scenario at 26, double top scenario at 32.5, 33. Nice little W formation happening here. Keep an eye on FCX. If it breaks out, that pain that FCX has been going on, 52 all the way down to 25. Look at that. Just a nasty drop in price in a very short time frame. Has it stopped? The answer is yes. It stopped. That's not me answering it. Stopped right here. Support held. Worked its way back into resistance. I can't deny that. That's the price action. And so FCX, keep an eye on it. Nice little reversal happening on FCX. I also want to take a look at one of Coach Mark's names, right? One of Coach Mark's names. Mark likes a little bit of those high beta growth stocks. There's no doubt about that. He likes to sell naked puts on them. He likes to sell credit spreads. He likes to do covered calls. He's a theta trader through and through. There's no doubt about that. Let's take a look at Palantir here. A little bit of an ARC aggressive growth type company. Obviously, that's not a tackle 25 component because tackle 25 companies have to actually, be really, really, really good fundamentally, really great valuation, not hypothetically in the future. Are they going to be great? They got to be great today type scenario. Palantir, what I like about it, look at the time frame in the consolidation. Look at the time frame over the last month or two right here in that daily consolidation. That daily, the time frame it takes is really powerful sometimes. The time frame it takes, because what happens is all these moving averages come down, they converge against the price action, and you get typically a little bit cleaner of a type of price movement here. And so you're working off a double bottom slightly north of $7. You're working at resistance right here at about 860 on the daily chart. You come out to the weekly chart and you don't see anything yet other than the double bottom. Look at the double bottom, and the double bottom can be powerful. You don't see it on the daily chart because it happened all the way over here 5 months ago. Look at the double bottom happening. Wickety wick nonsense. Well, wickety wick matters if it gets confirmed. And look at this. It has a foundation of support right there north of 7. You're starting to work back up into resistance. You break out of the resistance level. It's a pretty clean distance all the way up to $10. Keep an eye on Palantir as well. We've been talking about reversal analysis, team tackle. I love you guys. You are the best community in the market. There is no doubt about that. If you've enjoyed the program here tonight, if you've enjoyed the reversal conversation we had in terms of the types of reversals, the process in the reversal, the 5 steps to the reversal, kind of getting a little bit of a deep dive into that mindset a little bit. Give us a nice little like and share. Tell somebody else about tackle trading, but that's who we are, guys. We love the markets. We love our community, and if you want to be a part of our amazing community at Tackle Trading, you can always go over and test out Tackle Trading on us. we're that confident that you will love tackle trading. And guys, we have a tremendous amount of content in our pro member community. On YouTube, we do the halftime report, we do trade masters, we do a tackle 101 series about every 2 to 3 weeks. But in our pro member community, ladies and gentlemen, we're having these conversations every day. We're having these conversations every day in the Traders Lounge. We're having these conversations every week in the coaches shows, in the Cash Flow Club, and every single weekend we're putting together some of the best reports in the entire market called the stock, the options, and the commodity report. You couple that with the Tackle Trading newsletter. There's not a better community for the value. There's just not. And so if you want to give tackle training a chance, you can do it on us. Test it out. 15 days free on tackle trading. Ladies and gentlemen, you get everything I talked about. You get it for 15 days. You get a free trial. So go ahead and check that out. You can visit bit.ly/join tackle pro. You can email us at team@tackle trading as well. You guys are the best. And Kevin, I can't do it this month because Coach Greg has the mastermind. Oh, by the way, those masterminds, I love those masterminds. But next month for the Step System Mastermind, deep dive with Coach Matt, Elliott Wave Theory, Fibonacci, and depths of retracements. Oh me, oh my, we're going to have some fun. For all of tackle trading and for all of you guys out there in La La Land, you guys have an absolutely wonderful, wonderful, wonderful rest of your Monday night. I will be with you tomorrow in the halftime report with Coach M, breaking down all the market activity. And we got a lot of earnings to navigate this next couple weeks. So come hang out with me in the halftime report if you want to get a little, have some fun on a daily basis in the market. We bring market commentary a little bit quirkier, a little bit funnier, and a little bit more entertaining, and definitely more accurate than others in the market. So definitely be there as well. You guys are the best. We are out for tonight.